G'day everyone. Glad to see that you're here. Just while we wait for some people to jump in. Firstly, can you just let me know that you can hear me? If you can type that in the chat. And then secondly, if you can just let me know where you're tuning in from. That would also be fantastic as well. I am a one-man band here at the moment. So in terms of the questions, it'd be great to get some. But if we can put them in the chat on the right-hand side. Awesome. Thanks, Paul. Appreciate it. So what we'll do is we'll just wait for another minute or so before we kick off into things, just to give any latecomers a bit of a chance to get started. One of the first things we'll do while we're waiting for them is I'll just put up a bit of a poll on the right-hand side, or it should pop up on your screen. And what this is just asking, just so I know, how many properties have you got? Are you currently at 0, 1 to 2, 3 to 5, or 5 plus? Just to sort of give me some indication as to where we are at the moment in terms of audience, and then we can tailor what, or the content's going to stay the same, but it'll just change the delivery of it slightly depending on how the room sits. Awesome. Thanks, Simon. G'day, Ben. Great to see you guys are in here. Praful, good to see you as well. Cool. So we've got a bit of a mix here of some people that are just starting out. It's all pretty even, and then the 50-50 with, or the 50% with 1 to 2 properties. So that's awesome. What we will do is kick off the slideshow now. G'day, Trent. I'll click into the slides and we'll get going with that. And then in the chat bar, there's also, it says chat and then Q&A only. As we're going through, if you've got any questions, if you can put them into the Q&A only section, and then what we'll do at the end is I can come back through, review them and answer your questions. As I say, because it's only me here at the moment, I haven't got someone else I'm talking to today. It's going to be hard to go back through and have a look at them at the same time. So those poll results should be up now for you to see. We're at 16% for just starting out. 50% of you have got 1 to 2 properties, 16% at 3 to 5, and then 16% at 5 plus, which is great. So let me just kick off with the presentation for today. So presentation for today is around how to invest safely in real estate without taking unnecessary risks. So this is probably one of the things that people sort of skim over, don't know the full process, and maybe even sometimes take some risk without even knowing they're taking it in the first place. To give you a little bit of background about myself, my name's Hadley. I'm the founder and director of New Zealand Property Buyers. I personally started investing back in 2006. So 2006 obviously had a whole lot of resemblance to what sort of happened in 2020, 2021. I got caught up back then when everyone was saying to me, hey, look, property prices are never going to be the same. If you don't buy now, you'll never be able to buy. And I took a bit of the wrong advice. I made some of those risks took some of those unnecessary risks that we're talking about today, and put me in sort of a spot of bother for a number of years. Fortunately, learned from my mistakes, and then so it's really good to be able to put some of that learning together for you guys today to run through that. So the other thing that we did off the back of that too was we've started a buyer's agency company. So we help investors go and purchase property without taking the same amount of risk that they're potentially going to themselves. And then we've also got a project management and a property management company that we run as well. In terms of the agenda or the layout for today, we're going to talk about the hidden risks, the strategies that we use with our wealth or with all of our investors, which turn them into wealthy investors, why data-backed decisions become so important, and then mastering the 4 quadrants of risk. After that, what I'm going to do is open up for Q&A, and then right at the very end, there's also an opportunity to book a call with me. I'll put that up on the screen as well, just so everyone's aware right from the start. And as I say, any queries or questions as we go through, if you can put them into the QA only section, that would be great. So The first thing that we want to talk about is why is the due diligence that you do so important, and how's that tied to hidden risk? People that haven't got quite so much experience, or investors in general, when they start to get comfortable on things, start to skip steps. I've bought 5 properties. I've bought 10 properties in my life. I know what I'm doing. Let's just go. It all looks pretty good to me without any sort of background knowledge or any sort of deep diving into it. And it's really important to remember that when we're doing our due diligence, that we're spending some money up front. It might be $1,500. It might be, we've just got a bill yesterday from a client we're doing some work for. There was $2,500 for the building report and meth test, which may seem like a lot on the front end. We want to make sure that we do this once the property is under contract, but also too, we want to make sure that we do it because we're better to spend $2,500 and find out that the property is not right because there was something hidden in there that we didn't know, rather than going, I want to save myself $2,500 and then spend $1 million on a property to find out that the $1 million was the costly mistake. And in terms of that, when we look at the risks or the flow-on effect from those that skip in due diligence, I've got a couple of worst case sort of scenarios here, and this is from my own personal experience. Scenario 1, which is the budget blowout. So this one here happened back in 2016. What we did was we went and we bought a house, and the saying of good isn't always cheap and cheap isn't always good rings really true here. So what happened was 2016, we bought a house for $200,000. Didn't do quite enough due diligence on it around quoting, finding out what prices really were. Got one quote and thought, yeah, we've done a reno before. Everything's going to be nice and easy. What this project turned into was a repile. And by the time we got the quote back for the repile, that was all sort of nice and easy, $15,000 done. But what we didn't account for was that the exterior needed repainting. The builders decided they were going to take, there was like fiber cement cladding over top of the weatherboards, which we were just going to leave there, but the builders decided that they were going to take that off. And luckily it wasn't a complete reclad because the weatherboards were still in really good condition. But what happened was the piles got redone, but then it cracked everything inside the house as well. So we went from just doing like put some carpet down, paint things, put some new doors on, and it should be a pretty much cosmetic reno inside, to a major full-blown reno with, windows that didn't shut, doors that didn't shut, cracked walls, everything that was, well, it wasn't level, but when we re-leveled it, nothing decided it wanted to do what it had previously done. So looking back on that now, if we'd gone back through and done our proper due diligence on the project around, right, cool, the repiling's only $15,000, that's not a big deal. But what's the flow-on effect for that in terms of what's the rest of the renovation going to cost? How much, collateral damage is there going to be when we relift the floor 100 mils on each side? What's that going to put things out by? And so it's this due diligence and thinking that becomes really, really important when we're looking at these. The thing for that one there too, and as part of the due diligence was that you've also got to figure out what you're going to do to get out of the property as well. So we were lucky with this one. This was supposed to be a flip, which turned initially into a very expensive flip. But then because the way it was set up, we were able to turn it into a boarding house for 12 months, waited for the market to lift a little bit more, and then on sold it. If it hadn't been set up in that sort of configuration that we had it as an exit strategy, it would have made it far more difficult. We probably would have maybe broke even if we were lucky, and it definitely wasn't worth the hassle and stress of going through everything. Scenario 2, subdivision gone wrong. So this one here is one that we recently I was looking to purchase, and we went through the process, had a look at the house, everything looked good. But before we put the offer in, we had a really good look at the title, because it was a section that was a cross lease, but had been converted back into a freehold title. And so we'd done some rough numbers as that, right, it's in the medium density zone. That's all good. There should really be no issues here. But what happened was that the title had a whole lot of easements across it. So it was more or less like they'd put a cross across the entire title, excluding the original house, and then run other sewer lines that were easements that were sort of 2 meters wide around the perimeter of the property. So the initial due diligence there, we sent it off to the lawyer and had a chat to a surveyor and said, hey, look, what's the cost? What's it likely to happen? Made the project that looked from the outside like a really good option, a really, really bad one, and one that was going to be sort of too hard to do. But if we hadn't have done that, and then we're going to spend some money or some more money to go and figure these things out, we're just going and bought the house in the hope that that's what we could do. It would have turned into a much more costly situation. So when we talk about the risks that we need to be aware of, so zoning issues are a big one, and it's not always a case of just taking for granted what the zoning says. So to give you an example of this, up in Whangarei, in the general residential zone, you can place 2 houses on a property. In the medium density zone, you can put up to as many houses as you can before you breach the impervious area percentage in the district plan. The thing that isn't quite so obvious is that as soon as you go over 2 houses, so the same as what's in the general residential, you then need to apply for a resource consent. So to go, right, cool, we're going to buy something in the medium density because I know I can just, as of right, go and put up 5 townhouses on that particular site. There is the resource consent issue there that can potentially come out and bite you. So understanding all those zoning rules is really important. And then having the people to go and talk to and just check that what you think is going to happen and what can actually happen are the same things there. The unanticipated maintenance. So that's really around not doing our building reports. Even if you've bought a number of houses, it's still worth going and getting those building reports to find out, exactly where things are. Even if things aren't bad, it still gives you a chance to put a maintenance schedule together so that, or even if there are some repairs that need to be done, we can then sit there and go, well, how important are these? Does this need to be done this year? Is this something that we can put off for 12 months? And then just to go back to the previous property that I talked about with the repiling, the other issue that we had there too was that we did it in the middle of winter in Palmerston North. So when it came to trying to paint the exterior of the property and plaster the inside, we had huge delays because of the weather and the cold. And there was a period there too with the rewiring that we didn't have power in the house. So we were also limited there in terms of what we could do as well. So really important. Around the tenant issues. So important with these two, that the areas that we're purchasing property, that there's a sustainable population and there's sustainable work there for people as well. Recently there's been a number of bigger companies that have shut down or plants that have shut down. A couple in the Ruapehu district at the moment, where there's a lot of jobs, and the main employer in the centre has decided they were going to shut down. The risk then becomes, what happens if that shuts down? What are you going to do with your property after that happens? And then who's going to tenant the property once that's done as well? So important to get an understanding of the type of tenants, who's going to tenant it, and are there any things that you can see that are going to prevent you from being able to carry on with that? Title defects. This one here more so comes in for people that don't get their lawyers to check things. People that go and decide to put cash offers on properties, take out the title requisition section, and then go to their lawyer and say, "Hey, look, I've just purchased this property. Can you do the conveyancing for me?" To then go and find out that there's a title defect on the property thereafter, whether it's a cross lease title that the flats plans out. It then makes lending really hard. And some of you might be sitting here going, that doesn't happen. I can assure you it does. There's the mortgage brokers that I talk to sometimes also get the same thing with, "Hey, I've just bought this property. there's a couple of issues with it. We're unconditional. I need to get some money, and oh, by the way, half the house isn't consented, and the title's got a couple of things I'm not quite sure about, but we should be good. And banks don't lend on defective titles. New builds. This one here, I've put in here as a risk to be aware of, just from the fact of what's happened over the last couple of years with house prices. So I'm in a place in Auckland at the moment that's got 100 townhouses in the development. People paid $1.2 million for these developments back in 2020. They're now getting offers for the people that need to sell them at sort of 900,000. And then also with that too is the rents they're getting is sort of $150 a week less than what the developer told them they could get at the time. So the reason that this is a risk is the fact that if you've got a number of houses that are all the same, and this is a call that we get from people as well saying, hey, look, I've got this townhouse. I purchased it for 900,000. The neighbor just sold theirs for 750. Is there any way that I can get my price back up to at least the 900 so I'm not losing money? And the short answer for them is no, because if you've got identical, the way the property market works around comparables is that as soon as you've got one comparable house there and then you stick another comparable house beside it and one sells for 750, well, all of a sudden there's your market value in the market. The same with rents, that if one person has to drop their rent by $100 a week, well, all of a sudden it becomes the standard for the area. And the thing with them, and when they all look the same, there's really nothing you can do. You can't add some value by renovating because they're brand new houses. You can't go and put a cabin out the back because generally, to try and increase your rent, because generally there's not enough room, or you can't get the cabin in there. It's extremely costly, or there's covenants on it. So there's a whole lot of things that you need to think about and think through during that process. And that's the same with purchasing existing property as well, is you've got to think through the future term risk of, hey, what's the risk of me not being able to tenant this? What's the risk of me not being able to sell it if I need to sell it? Have I got some nuance here that I can change? And so that, if things don't quite go right, what's my exit strategy? What can I do? How can I lift cash flow? And these are just sort of some of the things that we need to be aware of when we're going through our due diligence process. So some of the strategies for wealthy investors and why is strategy so important? It's one of the things that we see all the time where, and I think it's just a Kiwi thing as well, where we love to go and look at houses. Everyone jumps on Trade Me and has a good look. And we also get it as well when we talk to people, is that it's like, oh, hey, if I've seen this house on Trade Me, what do you think? And the real question back to those people is, well, what are you going to do with it? So instead of us sitting there and going and looking at houses first and looking at 37.5 listings that are on realestate.co at the moment, what we need to do is come back and work out what our strategy is. So what are we looking to achieve from a strategic perspective? Are we looking for cash flow? Are we looking for equity? Are we looking to land bank something? Are we just buying a bare development site? And then what we need to do is go and look at those areas that support that strategy. So, for example, not that I recommend the West Coast of the South Island to anyone, but if you were looking for solely cash flow and you weren't worried at all about what the market was going to do, you were solely chasing a yield and you were looking for the highest yield in the country, you'd head for the West Coast. Once again, there's risk there in terms of population, isolation, and things like that as well. But that would be an area that you'd suit. And then you'd look at the 300 or 400 houses that are for sale on the West Coast. Just like if you were looking for a land bank with a really good subdivision opportunity, you'd probably look in Auckland, but you wouldn't get the cash flow in Auckland at the same time. So working out those strategies and figuring out why, what you're looking to do, the areas that suit that, then property being the last thing that we're looking for. And then as part of that as well is that we want to start looking at the worst house in the best streets. So the other thing to look at too with markets is that owner-occupied streets go up in value more than what rental areas do. So owner-occupieds drive the price of a market rather than investors. So if we're looking for a property that's got a really high amount of renters in the area, rental properties in the area, we've got two issues to sort of look at. Number one, the price is going to be driven in the area by investors and what they're willing to pay. But secondly, if there's a whole lot of rental properties there and there's a whole lot of rental properties on the market, then you've got a situation where people have got free for choice. So they won't necessarily have to come in and buy, look at your house, as opposed to a suburb that's more owner-occupied friendly, where people want to live in the suburb, they haven't got the money to, but they're quite happy to rent there, or they want to rent there, and there's 3 houses on the market. So people are going to compete, and the rental price is also going to go higher in those suburbs as well. Positive position. I think this is something that a lot of people don't look at well. They go, oh, I just need cash flow, and they forget yield, or they forget equity. But then they also don't look at their combined position as well. So conversations that we regularly have, people say, hey, look, I'm just after really high cash flow, and I want to buy 4 properties this year, or 4 properties over the next 2 years, but they haven't got a whole lot of equity sitting there as well. Or people dismiss a deal because they go, it's running at a $4,000 loss for the first year when interest rates were higher. I can make $100,000 worth of equity out of this, but it's not quite right. But the thing that they're missing out on here is that if they had a cash flow property of say $4,000 a year, and just for my easy maths, it's going to take them 25 years, and that's without taking inflation into account, to meet that initial $100,000 worth of equity that they've made. So looking at our combined position becomes really important, so that we can work out, right, if I add my equity and my yield together, what does that overall position look like? And then how does that push me forward from a strategic position? And then Goldilocks Street. So we don't want stuff that's overvalued and in the top 20% of the market. We also, most of the time, don't want to go to the bottom 20% either. And the other thing is that there's some desire to live in the streets. So, and this comes back again to the strategy that we're implementing. The desirability and the undervalue. Sometimes for some clients, from a strategic perspective, we go and we buy lower value property or in the lower socioeconomic areas, because we know we can get longer term tenants through social housing and things like that. But then we can do things like subdivide blocks of estate houses up, and there's some equity plays there. But it's important too, and I think something Kiwis tend to do is we tend to look at an area, or there's stuff online at the moment that says, hey, look, Gisborne's overinflated by 20%, or Wanganui's overvalued by 20%, so we wouldn't go and buy in Wanganui. The issue with this is it takes everything into account. We need to be looking at suburb and street level data to see, how things are actually and truly performing, as opposed to looking at a citywide sort of view of things. Northland's, exactly the same, where they say like the median value is 770 odd thousand. The issue with that is that they take the $250,000, $300,000 properties in Kaikoui, but then they also take the $20 million waterfront properties that sell around Russell into exactly the same mix. So your data is very, very skewed. And then to go back to Wanganui, there was also the issue, or the thing of, look, Wanganui is overpriced and you don't want to overpay there. At the same time that these things were happening, we were in a particular suburb in Wanganui, and our values have increased sort of 4% a year since the downturn. So it's really important that we are focusing on streets, suburbs, and knowing those really well in our due diligence phase, as opposed to, I've read this on the internet, it says that, this is a bad place to invest. So, bad place to invest. And the strategy that we use for our successful guys, and this is and by successful, I mean all of our clients, our aim is to make everyone a success when they come through, and that's using leverage wisely, but then also building a great team around them as well. So, the way that we finance, the way that we structure things becomes really, really important, and working with good people to help you in your strategic view of finance becomes really important as well, because you can talk to one mortgage broker or a banker that's not that great. You talk to another one that tells you how you can do things. And I think that's really important with people, is just get to the point where it's like, hey, look, this is how we can do it, or find people that can tell you how you can do things, rather than being surrounded by people who tell you that you can't. So what we're going to do is just run through some recent case studies that we've purchased. I can give you some insight into why we've purchased them and the strategy around it. So this particular property here, lower socioeconomic area, but what we needed in this one was to really ramp up the cash flow. So Susie was after high cash flow property. She's got 2 of them now, and then she's got a property that's got a whole lot of equity tied up in it, but it's not performing as well as what it should. So what we're going to do is, we've got a really good base now from a cash flow perspective. We're going to look to sell her one that's underperforming, and then reinvest that probably back into a more equity focused property, just so that we can keep everything fairly balanced and ticking along. This one here was one that we haven't quite settled on yet, but we purchased for a client a month or so ago. So Johnny and his wife came to us wanting that they've got a reasonably large amount to spend, and we've broken that up into a few different purchases. But this one here, the yield's pretty good at 8.4%. The beauty with this one is that we're also in a situation where the property is subdividable as it is, and came with a resource consent to do so. So where this one is in Martin, you can't buy a house for 300,000. They're sort of mid threes up, and we've sort of seen it at about sort of the 380 a pop mark. So we're in there for 760 once the place is subdivided, and it's about 15,000 to subdivide that. So main strategy in here wasn't super high cash flow. It's how do we increase some equity and then keep our head above water with the yield side of things. This Gisborne property, I'm probably going to look at this and go, jeepers, that's a low yield for Gisborne. What this is it's a house that's got a garage that's got some converted bathroom out the back. So we went and did some research on it and found out that what there was that the section size is big enough for a secondary dwelling. The dwelling that's there is in the right position and close to everything, so that we can hook up for the wastewater and things like that. And then once we get another $450 a week for the back section, for the back converted garage, then we're going to lift this price up. Then we're going to lift the yield up as well. So it's really important that when we're looking at property, that we're not only looking just at what stage 1, but what does stage 2 look like for us? If we buy this today at price X and we add Y to it, what does the final number come out as, rather than being sort of short-sighted on, hey, this yield doesn't work today, so therefore it's a bad property purchase. This one here, it was a cheap house for Napier. Got it at 505,000. You can see the yield on it's 7.5%. And this rental is for when it's all completed. So it's just going through a renovation at the moment. What we're going to do with this is the front house needs about $100,000 worth of work doing to it. Then we're going to put a secondary dwelling onto the back of the property. And then what's going to happen there's a couple of things that are going to happen. There's this house here that obviously we've bought it at 505, needs 100 grand on it. We're at 605. But also what's happened too is that 3 houses down, there's the identical floor plan that's just gone on the market for 765,000. So if we were a bit conservative and said, hey, look, we're here for the place is valued at 720 once the house is renovated, then we've sort of made 115 grand from an equity perspective. So we've made just over $1 for every dollar that we've spent. And then we need to put the secondary dwelling on the back of that as well, which is then going to bump that rent further up. This one here, so you'll see $1,700 a week for rent, and the purchase price $540,000, and a yield at 7.4. Doesn't quite look right in terms of the numbers, but I'll tell you why. So what happened with this one is that we bought it for $540,000 in Whangarei. The properties in the medium density zone, and as I mentioned to you before, we can get away with 2 houses in the medium density without resource consent for a third. But what we've had to do for this one, and because of the way the house is, we've shifted this house back about 15 meters. We've put another house in down the back behind it, and then there's another house that's coming here at the front. So the rental appraisals that we've got at the moment sit around $1,760 per week. The rental yield at 7.4. But once the project's done, there's about $350,000 to $400,000 worth of equity that sits in this property from the deal being complete. So once again, the guys that own this one, they're chasing equity. Their cash flow position is good. But what they're looking to do is to go, right, how can we bump our yield up a bit? How do we get our equity? And then how do we give ourselves a really good footprint in that particular area? This one here is a client that we've bought 3 properties for. This one here we purchased it at $275, 10% yield, $635. This one we bought at Christmas. We were the only people at the auction, and it was a bit of a desperate sale. So we did fairly well out of that one. This got revalued back up at $410,000. So there's been a really, really good chunk of equity for that one. There's not too much more that we can do with this without undertaking some really major work. But as an overview for it, it was a good play from the yield, and then also the equity kicked in. These two here are side-by-side properties. We bought them sort of similar times. But the thing is, down the side of this one, there is a fence that we can do. And what we're going to do is we're going to put 2 more buildings out the back of the property as well. So similar to the previous slide with Stephen's property, we're going to bring in a couple of relocatable proper houses rather than cabins into this one, put them on the back of each section. And then that's going to allow us to increase our yield, increase our value from those relatively low purchase prices. This one here, from a purchasing price perspective, is sort of at the other end of the Gisborne one. So we've got a range of Hastings, Wanganui, Napier. This one here in Wanganui is the one that's growing incredibly well. At the time that everyone said, Wanganui is overpriced, don't purchase there. So this particular strategy is to buy bigger blocks of units, bigger land area. Obviously, you need a lot more capital to be able to do these type of things. But there's subdivision potential out the back of these Hastings ones to build another 6 units out the back for sort of future development. The yield on it sits pretty well. The Wanganui ones, there's also potential to put something out the back of those as well. Rental yield at 8.52%. And then this one here is in Napier. It was sitting on the market for a long time. The vendors initially wanted 1.7 for it. We got them down to 1.204. And then the beauty with this is there's a main house here that's got an attached sleep out. Then there's another 3-bedroom house that you can see the roof on here. And then there's 2 other 1-bedroom units at the back. So we've just renovated them. They're looking really good. And then so what we're going to do here is we're just going to sit on them for a while until a time that we need some more equity. And then once we require the equity for them, we'll go and subdivide them into 3 different sections. It'll affect our cash flow and our yield will drop a little bit. But at the same time, what it's going to allow us to do is draw some more equity out of those particular properties so that we can go and purchase some more. And all of these have been sort of strategically planned out from the start too. And probably, as you can see, from the likes of this one is main strategy for this, buy a single house. What can we do in terms of adding another building at the back of it? We've got to have some pretty good yield up front. And then what's the future value of that going to be? And then the same with these ones is that we're going to go and buy some bigger blocks of units with future subdivision potential or future development potential. And then that's going to set us up for our next moves. So when we start looking at data-backed decisions, becomes really, really important. So how emotions kill a deal. This is a really, really big one that puts a lot of people off or stops them in their tracks. And it comes back to sort of a little bit about what I've been speaking about so far. And the fact that, who do you get your advice from? Where do you get your information from? How far down are you drilling into the information? Because that becomes really important as well. To go back to the Wanganui example, there's the don't buy in Wanganui because, it's overvalued. Turns out there's parts of it that aren't. But there's also too, we've had clients that we've shown them the property, shown them the data, and they've gone, I spoke to my friend who lived in that area 15 years ago, and they thought it was a bad place to live, or they wouldn't buy an investment property there. And then the questions from that come to be, okay, great. How many houses does your friend own? How many times have they bought property? And when was the last time they were back there? And the general answers tend to be, they've bought the house they live in, they haven't been back there for 5 or 10 years, and they don't really know anything about property other than, it's a bad place to invest. Places gentrify, places change, so it's important to keep up with the data, and also to keep up with what's happening, and just be really mindful about the advice that you listen to and the advice that you take on board. So the other thing too is especially with summer coming up and the summer barbecues, there's going to be a lot of people that have an opinion on property. I suppose opinions and property are a bit like backsides. Everyone tends to have one. And so it's really important just to get an understanding of, if someone's going to give you some advice, find out what they've done. Find out their understanding. When was the last time they bought the house? Family are really good at giving you advice, and their advice always comes from a place of love and wanting to protect you and help you. But you've also just got to understand that, their experience, and are they telling you stuff that you shouldn't do out of fear because they don't know how to do it, or they got burnt once, or is it out of, actual knowledge and practice themselves? Why long-term thinking is better than short-term? So this alludes back to what I was saying before about the two-stage buying. So we always want to look at, where are we today? What are we buying today? And then what's that going to look at in 10 years' time or 5 years' time? Property is not a get-rich overnight asset. It's something that takes a chunk of work. It takes some asset appreciation, and it's also time in the market. I don't think, from anyone that bought houses in the early 2000s, I don't think you'll ever talk to any of them that go, oh, jeepers, that house I bought for 100 and I only wanted to pay 120 grand for that house, but I paid 125,000. I think I overpaid for it. No one will ever say that 15 years on. Because inflation and price creep and everything else just doesn't allow that to happen. So we've got to look at all these with a long-term view. And the same from like a cash flow and a position view as well, that if we're solely looking at cash flow on year one, and we don't factor in things like rent increases, changes in interest rates, that if we just go, right, house number one is here, the interest rates at, the 6-month rate says, 6.39% or whatever it is today. Therefore, it's negative cash flow, $10,000. Therefore, it's a bad purchase. It may not be if you look at the interest rate on a 1-year rate or a 2-year rate that's nearly 1% lower at the moment. It might cost you $5,000 for the first year, but then when you have a rent increase the following year and do some renovations, all of a sudden the second year is down to $1,000, the third year you're positive, and the fourth year you're away. And then you also need to look at the accumulation of that. So, year 1, year 2, year 3, you're at a loss. And then potentially, most times what we see is like by year 5, sometimes year 6, you've paid back those cash losses from the first couple of years. But then you've also got the accumulated position down the bottom of the equity that you've made plus the cash flow. And then when you look at it in 10 years' time, you go, jeepers, that's a pretty handy little property to have. So what we need to consider, when crunching the data. I think we've covered most of this already. But just to recap around suburb over area data. So by that, what I mean is like look at the suburbs, don't necessarily look at areas as a whole. Knowing your strategy and goals, so that's where you need to start off things. But also to comparing those or access to comparable sales, knowing what the local market's doing, knowing what you should pay for a property, and being okay to walk away if the vendors are unrealistic. To give you an example, we've just done this. We've just walked away from a deal today. There was 3 offers. We put in an offer mid-9s. They wanted to renegotiate with us. We've gone up like $1,007,500. They wanted 1.1. Well, the vendors wanted 1.1 for it. They've come back to 1.05, and then they're saying, "Oh, we're just going to wait for 1.05." If we were desperate, we'd go and pay the 1.05. But when you're 50 grand out for something, the numbers make a big difference. If we were 5 grand out, we'd probably have a conversation and go, "Hey, look, it's not worth losing the place over 5 grand." But 50 grand's a very different scenario. And you've always got to remember, there's always going to be another deal out there if you miss out on the one that you're lining up. The good deals come around fairly often. They just often change what they look like. But just buying something for the sake of buying something, or overpaying for something because the selling agent tells you it's a good idea. It's, or someone says, "Hey, look, if you overpay now by 50 or 100 grand, it doesn't matter because in 20 years time, everything will be fine." Not quite the same as the conversation, as what I said earlier about paying 1,000 or 5,000 more for a property. It really hurts your cash flow at the start. And then just on our last topic before we jump into the Q&A, what's high risk, high reward? High risk and low reward, and low risk, high reward. So what we want to look to be is on this lower risk, high reward side of the quadrant. And then we also, this is the side of things that we want to avoid. So the low risk, high reward may sound a little bit contradictory, but what we're looking to do is find assets that there's some nuance to, that we've got some exit strategies out of, and that what we can do is look to figure out that if this doesn't quite work, then can we do this? Then can we do this? And then if that doesn't work, can we sell it in a market that's not that's not right? But at the same time, we also look at that and go, well, if I buy this existing property at price X, and I spend 50 grand on it, and I make another 50 grand in equity, dollar for every dollar you spend at a minimum, then you've got low risk because you've factored in all of those things. You've got some different exit strategies, but the reward comes back to you. As opposed to, and I don't want to sound like I'm bashing new builds, but it's just the fact of that they're extremely high risk because you've got no control over what you do with them. The market does that for you, and the low reward as well. Talking to people that are shelling out $500 and $600 a week for a brand new townhouse doesn't make a whole lot of sense to me. The high risk part comes in because you're solely relying on the market to go up at any given time, and that growth is the thing that fuels your wealth, as opposed to the other side of it where you can force that appreciation. You've got options to subdivide, add a minor dwelling, do whatever it is that you need to do on the right-hand side of the quadrant here to keep you going. All right. Any questions that you guys have? If you want to, I'll give you a minute or so just to put anything in the chat bar there that you might have. Nothing coming up. Okay, that's cool. I'll give you a couple of seconds to think about it while we move on to the next bit. But so yeah, the last part of this, what I've got is a 15-minute discovery call with myself, complimentary. If you click on in the offers tab, if you click on the link there, that will take you through to my Calendly link. If you found some value for today, it'd be really good to have a conversation with you, find out where you're at, find out what you're looking to do, and then potentially how we can help you do that. Even if there's nothing we can help you with, it's always worthwhile sitting down, having a conversation. Conversation's better to have and find out that that things aren't relevant, rather than not having the conversation at all and thinking, yeah, if only. So with that said and done, there's still no Q&A in the or anything in the chat. So what I'll do is I will leave everyone to it. Enjoy the rest of your week. Sorry, Paul, do you have a process for looking at all local council rules to easily establish what can be done and subdivided? Yeah, so in terms of what we do with local councils is we've got planners that we work with in those particular areas. So it comes down to, like I say, having that team of people around you that know the area, understand the process, and can give some really good advice. So that's the important thing is building that team. I definitely don't proclaim to know everything about every council area, but as soon as we get something, it's like, right, who can we check with to know that we're on the right track there. Awesome. Anything else from anyone else? Cool. I will take the silence as no. No problem, Paul. If anyone's got any queries or questions, feel free to reach out to us on social media, through our website, and like I say, the offer's still up there. So jump on, book a time in my calendar, and happy to have that conversation. Thanks very much, everyone. Enjoy the rest of your afternoon. Have a great weekend, and hopefully talk to you soon. Thanks.